So thank you all for your time today. We'll get going. Just as I always do, a reminder that if you log into the website, go to support, and in today's case, go down to uh, financial VisionWorks and financial plans, and the tactics tab video, you will see a video that summarizes what we're going to have a look at today. And in this particular case as well, I also would recommend that you make sure you use the help button. So again, if we go to taxes, tactics, taxes, and the optimize taxes button, you'll see that there's a help button that will lay things out for you. So what I've done today is I've actually created three solutions. We're going to look at three tax tactics. So I wanted to organize them in a way that they were fairly clear on an individual basis. So we're going to look at sharing CPP, splitting pension income. Then we'll look at the optimization of withdrawals, which is to say, the blend of taxable and non-taxable income that you take out during retirement from a RIF, TFSA, et cetera. And then we'll look at the whole concept of melting down an RRSP, deferring OAS, melting down an RSP to try and maintain OAS in the future and not have it clawed back. So I'm in the split optimization solution. As you can see, everything is reorganized. So we no longer have certain features on the withdrawals tab. For instance, it's all organized under optimized taxes. And you can see that there are three panels. So one is for transferring donation, medical, adoption tax credits. They are transferred literally year by year, depending on who gets the greatest benefit from them. Sharing CPP, which you'll recall as or QPP, which you'll recall as a one-time election. And then finally, splitting pension income, which is something that happens year by year. There are also the withdrawal tactics and then the RSP RIF meltdown tactics. So we're going to focus first on sharing and splitting. You can go in, select a checkbox, click the calculate button, and see what effect a particular selection will have on taxes saved, OAS clawback. Net impact is the sum of the two. One might be positive, one might be negative. And then plan difference is the effect on the plan overall. And the reason for that is because there can be secondary factors like return on investment that play a role in the overall tactic. It's important to understand that this particular tactic applies through the life expectancy of the first to die. Obviously, transferring tax credits and sharing CPP, splitting pension income requires the two parties. So this would be disabled if you're dealing with a single party, for instance. So it's through the life expectancy of the first to die, less 1 year. And the reason we subtract that 1 year is in the life expectancy year of the first to die, there can be what I generally call estate noise. And that can definitely be amplified if assets, for example, are going to children from a previous marriage. So we don't want any of that impact to really affect the decision as to whether or not optimization should be used, through the normal life expectancy. So you can select the individual checkboxes, click calculate, but my recommendation is to click optimize. And the reason is that whatever the circumstances, VisionWorks will go through, automatically check everything and decide for you what the best approach is. So it's just by far the most efficient thing to do. Once you see that, if it's a positive result, then you would click OK. So I want you to notice the taxes saved are positive. The OAS clawback is also positive. You're reducing the amount of clawback, and the net impact then is the sum of the two, although the plan difference is actually slightly less. And again, that's due to secondary impacts such as return on investment and so on. So we'll click OK. And then if you want to apply this to the plan, you have to click the apply button. So you get to see whether this is worth doing or not, and then apply it. The reason for that, this is obviously self-evident when we're just doing the one optimization, but the reason is that we could combine different things. And so one may have a positive impact, one may not have a positive impact. It could be negative, so we wouldn't want to apply it. So you've got to consciously decide to apply the particular tactic. The one other thing that I want to just point out is this from auto and for tax purposes only. So in a circumstance, what can happen, and the way I've got this file set up, by the way, is that I have Bill earning a very large DBP. So he's splitting that. It's not just income from OAS CPP RIFs, for instance. So it's a large DBP income, which is being split. So the impact is the two lower income streams attracting less tax than one large one. Obviously, instead of having one large income stream along with OAS CPP, any RIF withdrawals, which would push Bill over the OAS clawback level by splitting the income stream. We're obviously keeping him under the OAS clawback level. And then we get that whole plan difference. Well, it could be that Bill is the person that has the majority of the income. Sue may not have much in the way of income. So the problem is that if we split pension income with her, she's going to have a lot of taxes to pay, which she otherwise wouldn't, but she may not have the cash flow to pay the taxes. So when you say for tax purposes only, this will split the income for the tax calculation, but then what it will do is it will have Bill pay Sue's additional income taxes. So that way, he's the one with the income. He's really the one paying all the tax. Now, that's just the additional tax over and above what she would otherwise pay if no splitting occurred. So that's the purpose of that. From the auto withdrawal is going to start as of his retirement when he starts receiving pension income, but you could make that later. That would be the case, obviously, if one person is retiring and the other's working for an extra 5 or 10 years. So you can push out the start date for the split depending on the particular circumstances. So I want you to notice 113, 48, 162, and 157, because there is one difference ultimately. When I click close and this is applied, I want you to notice that the actual numbers, the 157 net impact is less, it's 108, but the total plan difference is actually higher, it's plus 182. So when we do the calculation, we do it through the life expectancy of the first to die minus 1 year. But when it gets applied to the overall plan, because of the effects on Sue after Bill's death and so on, this is actually a calculation that goes through the life expectancy of the second to die less 1 year, again, to avoid any of that estate noise. And then the final thing that I just want to show you is that if you want to clear something, there's no clear button because things have been reset. So what you need to do, for example, is deselect the checkbox, click the calculate button, that resets everything, and then click apply. So that's splitting pension income. What we'll do next is we'll have a look at the withdrawals optimization. So I've just created a separate solution so we can look at it. And then we'll go to tactics, taxes, and optimize taxes, and we'll focus on this middle panel. So whereas splitting, requires a couple and you're transferring credits or sharing CPP or splitting pension income back and forth between two people, the withdrawals optimization applies just to an individual. And what it does, to use a simple example, is it says, take money from a taxable source up to the selected level, first bracket OAS, second bracket, and then if there's still an income need, take the income from a non-taxable source, a TFSA, for instance, so long as there are funds in it. Once the TFSA is depleted, what may happen is funds might be taken, for instance, from a non-registered portfolio, and in doing that, capital gains might be triggered, although they might likely be, relatively small compared to the amount of capital that's being taken out. But nevertheless, because capital gains are being triggered, what ends up happening is that the amount of RIF income, the taxable income, is cut back in order for the total taxable income to remain at that selected level, first bracket OAS, second bracket, whatever. And in this case, then, because it's an individual calculation, what happens is that it's through the life expectancy of that person, of that party, Bill's life expectancy, less 1 year, again, to avoid any of the estate noise. So let's just see what happens. I'm going to optimize from Bill's retirement. That's selected already. And I'm going to try the first tax bracket, click calculate, and we'll see what happens. So we actually get a negative total impact. So you can see the labels over here on the left apply to these fields as well. So more is paid in taxes, a little OAS is saved, but the overall impact is negative. If we try the OAS clawback level, then and click calculate, then we'll see what we get with it. And it's not quite as negative. And then I'm going to try the second bracket and see what impact we get from it. And you can see that it's, again, a little bit better, but still not great. So in this particular case, this is suggesting that doing that optimization, taking money out of the RRSP. Let me give you an example. Let's say our base rate is $20,000 of income due to OAS and CPP. And let's say we selected the first bracket, which is right now about 49,000. What that would mean is above our base level OAS CPP of 20,000 up to the 49, we'd be taking $29,000 out of a taxable source like a RIF. But then if we needed, say, 60,000, we would take the next 11 from a TFSA. So what this is saying is that would actually have a positive benefit for taxes, OAS, and the net impact, but the overall impact on the plan is actually negative. And the reason for that is if we go to the withdrawals tab, right now we've got the withdrawals initially coming from the non-registered portfolio. So what we're saying in this tactic is start to take money out of the RRSP right away, not after the non-registered portfolios are depleted. And as a result of taking money out of the RSP right away, as much as it may have a positive tax impact, we're also depleting the RRSP much sooner. And the RSP, of course, has assets in it that are growing at a compounded rate. So what we're doing is we're benefiting from the tax optimization, but we're losing the value of the compounding effect by retaining money in the RSP. So we have to look at the combination of these different factors to see, what we want to choose to do. So in this case, we would not, as I didn't, we would not click apply. So let's close that and go to our next example, which is doing a meltdown. And we'll go back to taxes and the optimize. By the way, if we don't want to apply something, of course, we would just close and not click apply. But if we did apply and wanted to change it, we would have to select no optimization and then do a calculation. So let's have a look at the RIF meltdown. What you need to do is decide what range of years you want to use, select the RSP meltdown, and then the whole idea, of course, is to defer something like OAS to, let's say, age 70, so that we're taking a lot of money out of the RIF initially, and what we're doing is we're trying to take less out later once the OAS clawback starts, so that we don't have that OAS clawback kicking in. So before I do this, we'll just have a quick look. So I'm going to go to the retirement tab, the OAS clawback, and you see that Bill's OAS clawback is projected to be about 19,600 over the course of his life, and Sue's OAS clawback is 17. So we're up in the whatever $37,000 range. And when we do that optimization, we're looking at the combined OAS clawback. I also want you to notice that if we look at Bill's RIF and the current meltdown, it's in the $60,000 range. So there's a factor here that we need to consider. If we go to tactics withdrawals, you'll notice that Bill's RRSP is selected, is available for auto withdrawals. So what that might mean is if we leave it selected and do the meltdown, not only are we going to take money out of the RIF faster to avoid the OAS clawback later, but we may end up taking money out just in order to meet the auto withdrawal requirement. So you could either deselect the auto withdrawal, or what you could do is you could put the from age out later in life so that it only is applied once we finished the RIF meltdown. So we're not getting any extra money coming out of the RIF in order to meet cash flow needs, that auto withdrawal factor. So let's go back to taxes, optimize. And I'm going to select 2025 when Bill retires. I'm going to leave it at 2029, his age of 69. Going to say I want to melt down any RSP's RIFs, and I'm going to change the OAS and, in fact, CPP start date to 2030. So keep in mind, there are a number of factors that are going to come into play here. One of them is not only are we going to take money out of the RIF, not clean it out, but only reduce the amount of money from the RIF, so that after the meltdown, 2029, 2030, then we still will have money coming out of the RIF, but we're going to take enough out now in order to reduce that OAS clawback, so that we don't have any clawback. So we're not taking it all out, we're just taking enough out to make that OAS clawback as close to zero as we can. So now we'll click calculate. And again, we see we've got that positive taxes saved factor, and we've reduced the OAS clawback for an overall benefit, but the total is actually again negative. And the reason, of course, is that we're taking lots of money out of the RIF now, and as a consequence, we're losing the effect of compounding. Now, you may mitigate this, of course, if you were to take some of the extra cash flow and move it into, for example, a TFSA, assuming there's TFSA contribution room over and above what the intended contributions are. So it would only really apply in that case, so that that extra income is then being parked somewhere where it's again able to compound tax-free. So if we close this, let's apply this, and then we'll close it, even though it's a negative value. We're going to apply it just so that we can have a look at the retirement tab in OAS clawback. So we can see for Bill, it's reduced. There's some money still coming out in 2036 that results in OAS clawback, but it's somewhat reduced. So is Sue's somewhat reduced. And then if we have a look at the RRSP withdrawals, we see that, sorry, I'm on Sue's tab, I apologize. We see that instead of being in that 60 range, they've been pushed up into the 120 range. But then in the future, they're much lower, keeping his income down so that it doesn't trigger OAS clawback in the future. You can see this one particular year at age 76, there's a very large jump up. There probably are very specific reasons for that. So those are the main things that I wanted to cover. Again, playing with this is also a function of going in and trying different combinations, and the different combinations will show up in the total fields down here. We are going to do one other thing that recently occurred to us. We're, in addition to the totals, what we're also going to do is show the estate output, the liquid assets, and the residue for distribution for both Bill and Sue. The question obviously is, well, why don't you try and automate all of this, you know, the AI thing? Well, the problem is that very often things that are good for wealth optimization may work exactly the opposite of what we want for estate purposes. So we may use non-taxable funds, non-registered portfolio money early in retirement, keeping money in RRSPs or RIFs, I should say, you know, during retirement in order for it to compound tax-free. But by doing that, we're using up our tax-paid capital, our liquid cash, which is the money we very well may need for tax plan or for estate planning purposes, terminal taxes, probate fees, etc. So in some cases, it may be better to take money out of retirement plans first, lose the compounding, which reduces the positive impact on wealth, but we're doing that in order to maintain the liquidity in the estate for tax purposes, and you know, which may be the greater concern for the client. If they have sufficient wealth, the wealth may not be the factor. The main deciding factor may be the liquidity of the estate. So in order to see how all of these interplay against each other, not only for total taxes, but also for the overall impact on the estate, we're going to add those fields. And I'm hopeful that we'll be able to do that in the upcoming week. So those are the things that I wanted to cover. Remember, click the help button. It will go through and give you all the step-by-step help on how to manage all of these new features. So let's open it up to questions. If you have questions, please unmute yourselves. And
so then the total plan difference down there, that number, yeah, that is that reflective of the income assets over time then?
Yes, exactly. So what we're doing is we're always looking at the value of income assets, not the value of net worth, but the income producing assets in the life expectancy year minus 1 year. And the reason it's minus 1 year is to get rid of all the random estate noise, especially if you're in a second marriage and have a blended family and, you know, taxes occurring because of a cottage going to children from a previous marriage. That doesn't change. So if we included that, then that would muddy the waters a little bit. You wouldn't see the effect of the actual tactic itself, because taxes and so on would have the effect of, you know, the cottage going to children from a previous marriage. So we want to get rid of any of those estate factors, so we can look at the tactic purely on its own. But just looking at taxes saved in OAS clawback and the net impact is not sufficient. You want to look at the total plan difference, the total effect on income assets, because of things like taking money out of a RIF early may save you taxes, may be good for the OAS clawback, but the problem is that because you've taken all that money out of the RIF, it's not sitting inside the RIF compounding tax-free. So that's an important consideration. And again, that's part of the reason why we're going to add that estate output.
Michael.
Because, you may take money out, it may not be positive for income assets, but it may be positive for the estate. And if the estate issue is your greater problem, or the client's greater problem, then we need to really see not just taxes, OAS, total plan difference financially. We need to see the effect on the estate as well.
Michael, it's Colin.
Yes, Colin.
Couple questions. When you did the withdrawal optimization and the RIF meltdown options, were the pension splitting still happening?
No, I did them separately, just so that we could focus on a particular feature rather than the mix of 2 or 3 features, all coming into play, because
So you could layer
affect each other.
So you could layer all this on top of each other.
Totally. But I wanted to make sure that we could have a conversation about each one of them. So I had split optimization, withdrawals optimization, and meltdown.
Okay.
3 entirely separate, scenarios to look at.
Okay. That leads sort of to another question. Is there any possibility, or would it even make sense to have sort of like a max optimization button, where instead of us trying 50 billion different things, we could just hit?
But that's the point that I was trying to make, is that there is no sorry, let me back up. A max optimization, let the software go through and do the AI thing and figure it all out for you. That's okay if all that's being considered is wealth, but it's not just about wealth. It's also about the effect on the estate. Yeah. So what sometimes is good for wealth, keep money in registered plans as long as possible, because of the compounding effect of returns, means I have to use my tax paid capital, my non-registered money first.
Yeah.
But if my issue is estate, then I need to hold on to my tax paid capital for estate purposes, because I need the liquidity to pay terminal taxes and so on.
Could you not have like a max for wealth, max for estate?
Well, they're opposites. And then if you're looking at max for wealth, and then you decide, okay, that's max for wealth, it's not good for the estate, but I'm going to put insurance in place, then you get into insurance premiums. I just don't think that I think it's important to understand the client, what's important to the client, and work with the client to figure it out. I don't think that in things like this, if you consider both wealth and estate, that there's a go button. Click the go button and here's your answer. I think that's true if the choices are, or the software's capabilities are much more limited. Then you can have a go button. But as soon as you get into things that get much more complex, otherwise we wouldn't need to. No one would need a financial planner to help them optimize taxes. Any other questions? Okay, so thanks for your time. We'll attempt to get this posted, although I may not. Well, I will. I'll post this video so that you can go back and replay it, but I will be doing another session next week, and hopefully I'll have that estate optimization or the estate output available, so that we can see how the tax optimization and the estate, affect each other, and the balance between the two that we're trying to reach. So thanks for your time, and I hope you have a great weekend.
Thanks, Michael.
Thanks.